When your income crosses $1 million a year, every dollar tells a story, and the IRS is always listening. This video is all about how to live large but stay invisible, how to enjoy the lifestyle you build without turning your tax return into an audit magnet. Let's break this down in 5 parts. Part 1, understanding how high-income audits really work. Part 2, the red flag million-dollar earner don't realize they're waving. Part 3, how to structure your lifestyle to legitimate entities. Part 4, real client example showing how we clean up potential audit traps. Part 5, the daily habit that makes you audit-proof without living in fear. So, as you listen, keep track of where we are. Each section built on top of the one before that. Let's start with part 1, how high-income audits really work. Let's start here because most people get this wrong. If you are making over $1 million a year, your odds of audits are 4 to 6 times higher than average. Not because you did anything wrong, but because your return is complicated, like multiple businesses, flow-through income, K1s, home office deductions, travel, depreciation, all those moving parts invite scrutiny. But here's the key. Audits follow patterns, not rumors. They don't start with your car or your watch. They start with mismatched data. A 1099 that didn't tie to your Schedule C, a partnership loss that doesn't reconcile to your basis worksheet, a charitable deduction that 10x your income bracketed average. So when we say audit proof, what we really mean is make your patterns consistent. Before we go deeper, let's pause for a transition and remind ourselves that we just covered the audit style. We will dive into what triggered them, the red flag high-income owner never noticed until it's too late. Imagine you are Market Health, a real estate developer in Austin, Texas. He earns about $1.4 million a year, drives a G-Wagon, owns 3 homes, and posts his private flight on Instagram. In 2025, Market's tax returns saw business deduction of travel and entertainment, car lease, and consulting. Individually, those are fine. Together, they look like personal spending disguised as business. Let's walk through the 5 top red flags that I love to see on high-income returns. Red flag number 1, commingling personal and business expenses. If your credit card, your PayPal, or your Venmo show overlap between business and personal, that is the easier path to an audit. Separate everything, have a dedicated account for every entity. Red flag number 2, unrealistic travel write-up. If you write up every flight to Maui as a business conference, you're not just pushing the line, you're erasing it. So keep proof of meetings, dates, and outcomes. Red flag number 3, large charitable deduction with poor records. When your donation exceeds 60% of your income, documentation must be airtight, appraisal, receipt, and contemporaneous records. Red flag number 4, unreported K1 or 1099 income. Every mismatch triggers an automated letter. It's not an audit, but it's how an audit begins. Red flag number 5, lifestyle mismatch. When your returns show $60K in income, but your public lifestyle shows $6 million, the IRS started asking, so where the money come from? Now, let's transition to what matters most, how to fix this before it starts. In the next part, we will talk about structure, because an audit-proof life isn't about hiding, it's about building the right structure that justifies the lifestyle you already have. Okay, let's come to part 3, the structure that protects you. So this part is where $1 million earners separate themselves from the rest. You can't just earn, you have to organize. So meet Sophia Kim, a physician turned entrepreneur in San Diego. She earned $1.2 million between her private medical group and her wellness product line. Her problem? She ran everything to one checking account. That means the IRS couldn't tell what was business versus personal. Here's how we restructure Sophia's work step by step. Step 1. Separate entities for separate purposes. Her medical practice stayed under an S corporation. Her wellness products went into an LLC. And she set up a family management company that handled payroll, rent, and shared services between the two. Step 2. Accountable plan reimbursement. Sophia started reimbursing herself for legitimate business expenses, home office, cell phone, and travel through a written accountable plan. That turns messy deduction into clean, compliant reimbursement. Step 3. Lifestyle segregation. She stopped paying personal items from business accounts. Vacations and personal meals were paid from her personal account, period. Step 4. Audit folder in the cloud. Every year, she uploads receipts, logs, and statements into a folder named Audit Ready 2026. If an examiner ever asks, she already organized. And here's the result. Her tax return didn't change much, but her audit exposure dropped dramatically because her structure tells a client story. Now, as we move to the next section, I want you to think of your own structure. Ask yourself, could someone look at your account and instantly see what business and what personal? If not, the next part is on you. Part 4, real audit trap we fix. So let's bring in some example because story makes the learning stick. So case number 1, the car that killed a deduction. A client in Scottsdale was writing up a $280,000 Range Rover under his consulting LLC. The problem, he couldn't prove business mileage. So we installed an automated mileage tracker app, documented every client visit and separate personal drive. That turned an audit risk into a legitimate 7% deduction. Case number 2, the phantom home office. A tax executive in Seattle claimed a home office deduction but worked mostly from co-working spaces. We fixed it by measuring and photographing her actual working space, documenting exclusive use, and creating a home office reimbursement policy under her S Corp. By next year, that deduction was bulletproof. Case number 3, the charitable donation gone wrong. The Family Foundation in Palm Beach deducted a $400,000 art donation. The problem, no qualified appraisal. We have them redo the paperwork, file the supplemental appraisal, and report the deduction under Section 170F. Each of the examples saw the same pattern. Documentation saved the deduction. Now, let's transition to the final part, where we bring this home and talk about daily habits, because no one wants to live paranoid, waiting for an audit letter. Let's talk about how to make audit-proof automatic. Part 5, daily habits, the audit-proof millionaire. Here's where the mindset shifts. Audit proofing isn't about living small, it's about living smart. Let's run through the 5 habits that keep million-dollar earners invisible and compliant. Habit 1, keep a same-day log. You can record expenses, mileage, and meetings within 24 hours. The longer you wait, the less credibility it looks. Habit 2, bank account discipline. Never mix personal and business cards. Even one target receipt on your S Corp card can open a can of worms. Habit 3, monthly reconciliation. Review your book every month. If something looks personal, flag it now, not when the IRS does. Habits 4, keep proof of your business purpose. A calendar invite, client name, or meeting notes is enough, but no proof, no deduction. Habit 5. Digital audit readiness. Upload receipt to your accounting software or cloud storage weekly. If an auditor calls, you can provide document in 10 minutes, not in 10 days. And here's the bonus habit. Avoid bragging online. Social media posts of yacht, and jewelry can attract attention you don't need. Audit selection isn't just math anymore, so data scraping play a role. So where are we now? We have covered first how audit really starts, 2 the red flags that trigger them, 3 the structure that protects you, 4 some example with audit cleanup, 5 the daily habit that keep you invisible. If you've been watching this far, here's your call to action. Don't wait for an audit letter to clean up your habit. Start now. Being wealthy isn't a risk factor. Being sloppy is. Audit proofing isn't about hiding, it's about clarity. So you want to operate cleanly. So document as you go, respect the separation between business and pleasure, and remember, when your income rises above 1 million, your lifestyle becomes part of your tax return. Make it a story that matches your paperwork and how you live large and stay visible. Thanks for watching. Hope you like, subscribe, and share the video with somebody you care. And remember, this is for educational purpose only, not tax or legal advice. I'm Mia, and I'll see you in the next video update.